$0.42. That is how much the FDIC has to protect every $100 in your bank account. Not $42, not $4.20, 42 cents. For every $100 you have deposited in an American bank, the government insurance fund that is supposed to guarantee your money has less than half a penny on the dollar. You have been told your entire life that bank deposits are safe. You have been told that the FDIC protects you. You have been told that $250,000 per account is guaranteed by the full faith and credit of the United States government. That is technically true. But what they did not tell you is that the insurance fund is almost empty. The math does not work. And if more than a tiny fraction of depositors need their money at the same time, the system collapses. This is not a conspiracy theory. This is not speculation. These are the FDIC's own numbers, published on their own website, available for anyone willing to do basic arithmetic. The banking system is built on a foundation of confidence. And that confidence is built on a lie. The lie that your money is safe, the lie that the government can protect you, the lie that 2008 cannot happen again. Let me show you the real numbers. And I warn you, once you see them, you will never look at your bank account the same way again. To understand how broken the system is, you first need to understand what the FDIC actually is and how it is supposed to work. The Federal Deposit Insurance Corporation was created in 1933 in response to the Great Depression. During the early 1930s, over 9,000 banks failed. People who had their life savings in those banks lost everything. There was no protection. There was no safety net. When your bank closed, your money was gone. The FDIC was supposed to fix that. The idea was simple. Banks would pay insurance premiums into a common fund. If a bank failed, the fund would pay depositors their money back. It was like insurance for your savings. You did not have to worry about whether your bank was healthy. The government had your back. For decades, this worked. Small banks failed occasionally. The FDIC stepped in, paid depositors, and life continued. The system built confidence. People trusted banks. They deposited money without fear. And that trust enabled the entire modern financial system to function. But here is what they did not tell you. The system was never designed to handle a real crisis. It was designed to handle isolated failures. One bank here, one bank there. A few $billion at a time. It was never designed for a scenario where the banking system itself came under stress, where multiple large banks failed simultaneously, where depositors lost confidence and demanded their money back. The FDIC Insurance Fund is not a vault full of cash waiting to pay claims. It is a small pool of money that works only as long as almost nobody needs it. The moment too many people need it at once, the pool drains and the promises become worthless. And right now, that pool is dangerously small relative to the deposits it is supposed to protect. Let me walk you through the actual numbers, because when you see the math, everything becomes clear. According to the FDIC's own quarterly banking profile, the Deposit Insurance Fund currently holds approximately $128 billion. That sounds like a lot of money. It is not. Total insured deposits in the American banking system are approximately $10.7 trillion. These are deposits under the $250,000 limit that the FDIC explicitly guarantees. When you divide the insurance fund by the insured deposits, you get the reserve ratio. That ratio is 1.17%. Let me say that again. The FDIC has enough money to cover 1.17% of the deposits it insures. That means for every $100 in insured deposits, the fund has $1.17. But wait, it gets worse. That $128 billion is not sitting in cash. A significant portion is invested in Treasury securities. If the FDIC needs to pay claims quickly, they would have to sell those treasuries. In a banking crisis, Treasury prices might be falling. They might have to sell at a loss. The actual available cash is even less than the headline number suggests. Now let us add uninsured deposits to the picture. Uninsured deposits are amounts above the $250,000 limit. Wealthy individuals, businesses, institutions. These deposits total approximately $7 trillion. The FDIC has no obligation to cover these. But as we saw with Silicon Valley Bank, when a large bank fails, the government often steps in to cover uninsured deposits anyway to prevent panic. Total deposits in the American banking system exceed $17 trillion. The insurance fund is $128 billion. That is a ratio of 0.75%, 75 cents for every $100. Not even a dollar, but I said 0.40 taus in the title. Where does that number come from? Let me explain. The FDIC fund has to cover potential losses, but bank failures do not result in 100% losses. When a bank fails, the FDIC typically recovers some value by selling the bank's assets, loans, and branches to another institution. Historical recovery rates average around 60% to 70% of assets. However, in a systemic crisis, recovery rates plummet. During 2008, some failed banks had recovery rates below 30%. When everyone is trying to sell at the same time, asset prices collapse, the FDIC ends up recovering pennies on the dollar. If we assume a stressed recovery rate of 40% and apply it to potential failures that could occur in a serious banking crisis, the effective coverage drops dramatically. The fund could be wiped out by the failure of just 3 or 4 regional banks. More importantly, if we look at the most vulnerable segment of the banking system, banks with high unrealized losses and concentrated deposit bases, the math becomes terrifying. There are approximately $684 billion in unrealized losses on bank balance sheets right now. If those losses become realized, if depositors flee and banks have to sell assets, the FDIC fund would be exhausted almost immediately. That is where the 0.42 comes from. When you account for realistic stress scenarios, when you account for the actual vulnerability of the banking system, the FDIC has less than 50 cents to protect every $100. The guarantee is an illusion. It works only if almost nobody ever needs it. If you think this is just theoretical, let me remind you what happened in 2008 and what happened in 2023. Because history proves that banking crises are not rare events. They are inevitable features of a system built on leverage and confidence. In 2008, 25 banks failed. In 2009, 140 banks failed. In 2010, 157 banks failed. Over 3 years, the FDIC dealt with over 400 bank failures. The deposit insurance fund was completely depleted. It went negative. The FDIC had to borrow from the Treasury to meet its obligations. Let me repeat that. The insurance fund that is supposed to protect your deposits went to zero and then below zero. The FDIC had to borrow money from the government because it could not cover the claims. The backup to your bank is the FDIC. The backup to the FDIC is the Treasury. The backup to the Treasury is the Federal Reserve printing money. The entire system is backed by nothing but the ability to create dollars out of thin air. Now let us talk about 2023. In March 2023, Silicon Valley Bank collapsed. It was the second largest bank failure in American history. Within 48 hours, depositors tried to withdraw $42 billion. The bank did not have it. It failed. Then Signature Bank failed. Then First Republic failed. 3 major banks in 2 months. The FDIC fund took massive hits. And here is the part they do not want you to know. The failures in 2023 were not caused by fraud or bad loans. They were caused by interest rate risk. The banks held treasury bonds, the safest assets in the world, and those bonds lost value when the Fed raised rates. If treasury bonds can destroy a bank, nothing is safe. The very asset that is supposed to be risk-free became the source of the risk, and every bank in America is holding the same assets. Every bank has the same exposure. The only difference is whether depositors get scared and run. After the 2023 failures, the FDIC fund dropped by over $20 billion. It is slowly rebuilding through bank premiums. But the pace of rebuilding is far slower than the pace of potential crisis. Here is what keeps FDIC officials up at night. It is not the next Silicon Valley Bank. It is the next domino effect. When SVB failed, deposits fled regional banks and flowed to the too-big-to-fail giants. JP Morgan gained $50 billion in deposits in a single week. The big got bigger. The small got weaker. The next crisis will not be one bank. It will be dozens of regional banks failing simultaneously as depositors flee to perceived safety. And when that happens, the $128 billion fund will evaporate in days, not months. Now let me explain exactly how this affects you personally, because you might be thinking, I do not have $250,000 in the bank. I am fully insured. What do I have to worry about? You have plenty to worry about. First, insurance does not mean immediate access. When a bank fails, the FDIC takes control. They try to arrange a sale to another bank. If successful, your deposits transfer to the new bank and you have access within a few days. But if no buyer is found, the FDIC pays claims directly. That can take weeks. During that time, your money is frozen. You cannot pay bills, you cannot make rent, you cannot buy groceries. In March 2023, Silicon Valley Bank failed on a Friday. Many depositors did not regain access to their funds until the following week. Some uninsured depositors waited even longer. And that was a single bank failure that the government prioritized. Imagine 20 banks failing in the same month. The FDIC does not have the staff, the systems, or the funds to process that many failures simultaneously. Second, your employer banks somewhere. Even if your personal account is safe, what about your paycheck? What about the company you work for? Businesses often have accounts far exceeding $250,000. Payroll accounts, operating accounts, reserve funds. If your employer's bank fails and their deposits are frozen, you do not get paid. It does not matter that your account is at a different bank. The contagion spreads through the economy. During the SVB crisis, tech startups across America could not make payroll. Employees who had done nothing wrong, whose personal banks were perfectly healthy, suddenly could not pay their mortgages because their employers were locked out of their accounts. Third, the system solution is inflation. When the FDIC fund is exhausted, the government has two choices: let depositors lose money, which would destroy confidence and crash the economy, or print money to cover the claims, which preserves nominal balances but destroys purchasing power through inflation. Every time the government has faced this choice, they have chosen inflation. They will print the money, they will cover the deposits, and then they will tell you that everything is fine, while the dollars in your account buy less and less. You might keep your $100,000 in the bank. But if inflation runs at 15% for 3 years, that $100,000 will buy what $60,000 buys today. You are made whole nominally, but destroyed in real terms. That is not protection. That is a different kind of theft. Fourth, bail-ins are now legal. Since 2010, regulators have been preparing for the next crisis. And one of the tools they have created is the bail-in. A bail-in means that instead of taxpayers rescuing a bank, the bank's creditors rescue the bank. And depositors are creditors. If your bank fails and there is not enough money to cover everyone, your deposit above the insurance limit can be converted to equity in the failing bank. You put in cash. You get back stock in a bankrupt institution. It happened in Cyprus in 2013, and the legal framework exists to do it here. So what could trigger a crisis that overwhelms the FDIC? What are the scenarios that keep regulators awake at night? Let me walk you through the 3 most likely triggers. Trigger number 1, commercial real estate collapse. American banks hold approximately $2.7 trillion in commercial real estate loans. Office buildings, shopping malls, hotels, warehouses. Since the pandemic, office occupancy has collapsed. Work from home is permanent for millions of workers. Office buildings in major cities are worth 40% to 60% less than they were in 2019. These loans are coming due. Between 2024 and 2026, over $1.5 trillion in commercial real estate loans must be refinanced. But the buildings are worth less than the loans. And interest rates are higher than when the loans were made. Many borrowers cannot refinance, they will default. Regional banks have the highest concentration of CRE loans. They made these loans to local developers, local businesses, local investors. As defaults mount, bank losses accumulate. The unrealized losses become realized, and the FDIC faces a wave of failures. Trigger number 2, a treasury market dislocation. Banks hold approximately $4 trillion in Treasury and agency securities. These are supposed to be the safest assets in the world. But when interest rates rise, bond prices fall. The banks are sitting on massive unrealized losses. If something breaks in the Treasury market, if yields spike suddenly, those unrealized losses explode. Banks that look healthy today become insolvent overnight, and the cascade begins. What could break the Treasury market? A failed auction where the government cannot sell its debt. A major foreign holder like China dumping bonds. A loss of confidence in U.S. fiscal policy. Any of these could trigger a spike in yields and a bloodbath in bank balance sheets. Trigger number 3, contagion and confidence. Bank runs are psychological. They are self-fulfilling prophecies. If enough people believe a bank is in trouble, they withdraw their money. The withdrawals force the bank to sell assets at a loss. The losses confirm the fears. More people withdraw. The bank fails. In the age of social media, bank runs happen at digital speed. Silicon Valley Bank lost $42 billion in deposits in 48 hours because of tweets and text messages. A rumor can become a reality before regulators even know there is a problem. If one regional bank fails and the media covers it aggressively, depositors at similar banks might panic. They might move their money to the big 4 banks. The flight from small banks to big banks could trigger dozens of failures in a matter of weeks, and the FDIC, with its $128 billion fund, would be overwhelmed immediately. So what do you do with this information? How do you protect yourself when the system that is supposed to protect you is underfunded and fragile? Step 1. Understand the limits of FDIC insurance. The $250,000 limit is per depositor, per bank, per ownership category. You can increase your coverage by using multiple banks, joint accounts, and different account types. If you have significant savings, spread them across multiple institutions. Do not keep more than $200,000 at any single bank. Leave a buffer below the limit. Step 2. Choose your banks carefully. Not all banks are equally risky. Look for banks with low commercial real estate exposure. Look for banks with diversified deposit bases. Look for banks with strong capital ratios. Avoid banks that have been in the news for instability. Avoid banks with concentrated exposure to any single industry. The too big to fail banks, JP Morgan, Bank of America, Wells Fargo, Citigroup, are more likely to be rescued in a crisis. The government will not let them fail because the systemic consequences are too severe. That does not mean they are safe. It means they have an implicit government guarantee that smaller banks lack. Step 3. Keep cash outside the banking system. Physical cash, paper bills. In a banking crisis, ATMs might not work. Branches might be closed. Digital transfers might be frozen. Having 2 to 4 weeks of expenses in physical cash gives you optionality. You can buy groceries, pay for gas, handle emergencies without relying on a system that might be locked down. If you have $500 in savings, keep $200 in cash at home. If you have $5,000, keep $1,000 in cash. If you have $50,000 or more, keep $3,000 to $5,000 in accessible cash. This is not your savings. This is your emergency buffer. Step 4. Hold assets outside the banking system entirely. Cash in a bank is a claim on the bank. If the bank fails, you become a creditor in a bankruptcy process. Your money is not your money. It is a liability on their balance sheet. Physical gold and silver are different. They are not claims on anyone. They do not depend on any institution remaining solvent. They cannot be frozen, defaulted on, or bailed in. They are money that exists outside the system. If you have $1,000, put $200 into physical silver, 5 or 6 1-ounce rounds. Keep them at home securely. If you have $10,000, put $2,000 into precious metals, mix of silver and gold. If you have $100,000 or more, consider having 10% to 20% in physical metals stored securely and privately. Step 5. Reduce your dependence on any single institution. Diversification is not just about investment returns. It is about resilience. Have accounts at multiple banks. Have some money in a credit union. Have some cash at home. Have some precious metals. Have assets in different forms and different locations. When the crisis comes, you do not want a single point of failure. You want options. You want flexibility. You want the ability to survive even if one piece of your financial life is temporarily inaccessible. Step 6. Monitor the warning signs. Watch for bank earnings that show rising loan losses. Watch for news about commercial real estate defaults. Watch for regional banks with stock prices collapsing. Watch for Treasury yield spikes. When you see multiple warning signs converging, accelerate your preparations. Move more money to safer institutions. Increase your cash holdings. Buy more hard assets. The people who got hurt in 2008 and 2023 were the people who waited until the crisis was obvious. By then, it was too late. Be early, be prepared. The FDIC has 0.42s for every $100 they promise to protect. That is not a safety net. That is a prayer. A prayer that too many people do not ask for their money at the same time. But the FDIC is just one piece of a larger system that is more fragile than anyone admits. There is a specific metric that tracks the real health of the banking system. It predicted the 2008 crisis. It predicted the 2023 crisis. And right now, it is flashing the most severe warning signal in 15 years. I reveal exactly what that metric is and what it means for your money in this video right here. Click it now. This is information that could save your financial life. I will see you there.